The next question we're going to deal with is PQ9-6. This question is interesting because it's mixing up Chapter 8 stuff, which is depreciation, and Chapter 9 stuff, which is interest. But it's perfectly fine because remember what I told you? It's like building a house. You have to start from the bottom first and build your way up. So everything in this course does connect. So let's jump right into it. You own a jewelry supply business supplying retail stores in and around Toronto. You plan to expand, and in order to do so, you require a computer system that will scan the barcodes of all products coming in and being shipped out. So you borrowed $20,000 from the bank on June 1st, 2016 at an interest rate of 4.5%. Okay. So what I usually like to do is I like to make checklist, right? As you guys already know, I like to retype out the information that's important to us. So the date. So let's deal with the bank loan first. So the date is going to be June 1st, 2016. And we borrowed $20,000. And the interest rate is 4.5%. And remember what we said before? Whenever we are given an interest rate, it is always for the full year. So that being said, this loan is for 18 months. It's doing 18 months, correct? It's not 4.5% for 18 months. It's 4.5% per year, which is for 12 months. Very important. So the loan is for 18 months. And you pay interest on the first day of every month. So now using that borrow cash, you purchase a computer system, including scanners for $22,000 on August 1st, 2016. Now we're going to talk about the piece of equipment that we actually purchased. Let's actually put this down here so we could do the analysis. So the piece of equipment that we actually purchased, the date was August 1st, 2016. And the equipment is estimated to last 10 years. So the cost is going to be $22,000. The residual value. So if you keep reading the question, the equipment is estimated to last 10 years with no residual value. So that's simply going to be 0. And then the useful life is going to be 10 years. So on the first day of every month, you pay interest to the bank. The year end is December 31st. Provide all entries from June 1st to December 31st with regards to the loan and the computer. So the chart is over here. We're going to do all the entries over here. So we have cash, equipment, accumulated depreciation, bank loan payable, interest payable, owner's capital, sales revenue, depreciation expense, and interest expense. So let's start off with the first transaction. So June 1st is when we purchased, June 1st is when we got the bank loan. So we got the bank loan for cash. That's the whole point of a bank loan, correct? So our cash is going to go up by 20,000. By the same token, our bank loan payable is also going to go up or increase by 20,000. Next, we have to do the interest calculations. So we have to first calculate the annual or the yearly interest. To calculate this, it's a simple formula. So the formula is going to be the amount borrowed multiplied by the rate. Remember, that rate is always a yearly rate. Keep that in mind. Very important, right? So we're going to take the $20,000 borrowed and times it by 4.5% or 0.045 to arrive at $900. Now we're going to calculate the monthly interest, which is going to be 900 divided by 12 months. So $75 per month. That's very important. So it fully tells you in the question that you pay interest on the first day of every month. So whenever we do interest calculations, unless stated otherwise, we're doing month-end adjusting entries. So we are doing month-end adjusting entries. All this means is that at the end of the month, we have to update interest expense and interest payable. And then interest is paid the first day of every month. So the very next day, we have to pay interest, meaning that we decrease interest payable and cash. Let's put that in practice right now. So on June 30th, we're going to update or increase interest payable for $75 per month. By the same token, we're going to increase interest expense by $75 per month. That the very next day is when we pay it out. So we decrease cash by $75 per month. And then we decrease interest payable by $75 because now we're fulfilling that obligation. Then the same entry takes place on July 31st at month end. We have to do an adjusting entry, meaning we have to increase interest payable for $75 per month. By the same token, we update interest expense. We do this because from July 1st to July 31st, we incurred 1 month of interest. So we incurred an expense, right? But the payment isn't until August 1st. But since this company does year-end adjusting entries, we have to update the accounts at year-end. Then on August 1st, we actually paid out in cash the very next day. So cash gets reduced by $75 per month. By the same token, so does interest payable. So interest is attached to bank loan payable because the bank's not going to give us money for free. They're going to obviously charge interest on it. And remember, interest is the cost of doing business to us. All right, so we also have another entry that's going to take place on August 1st because this is when we purchased the equipment now for $22,000. So simply put, we purchase equipment. So yeah, students might get confused that, okay, yeah, so the loan was for $20K and the whole point of the loan was for purchasing the equipment, right? But the equipment is $22,000. That's fine because the company might have other cash laying around and they might have used that cash as well to buy this equipment. So we're going to purchase this with cash. So we're going to distract this or decrease cash by $22,000. And by the same token, we're going to increase equipment by $22,000. All right, let's go up now and let's work through the depreciation calculations. Remember, the straight line method is cost minus residual value divided by useful life. The first thing we're going to calculate is the depreciable amount. Remember, the depreciable amount is a product of the first part of this formula, right? So this is going to simply be 22,000 minus 0. And then we're going to calculate the annual depreciation. So this is the second part of the formula. We take the depreciable amount, 22,000, and we divide it by the useful life. So in chapter 9, we recorded depreciation for the full year, correct? So in this case, we did it from August 1st to December 31st. However, since this is mixed up with this question and we're talking about interest, we're going to record depreciation expense at the end of every month. So that means we have to calculate the monthly depreciation. And this is going to be 2,200 divided by 12 months to get 183.33. So that being said, on August 31st, we're going to impact 4 different accounts now, right? So we're going to, let's first deal with depreciation. So accumulated depreciation is going to increase by a negative 183.33. Remember, this is a negative because it's a contract count, and by the same token, depreciation expense is also going to increase by 183.33. So now we're done the depreciation part. Now we have to do the interest part. So interest payable is going to increase by 75. And so is interest expense increased by 75. Then literally on September 1st, we're going to decrease cash by 75, and we're going to decrease interest payable by 75 as well, because we have cleared that obligation. Now, essentially, September 30th, October 30th, November 30th, and December 31st will have the exact same entry. So I'm just going to copy and paste it. Actually, let me do one last time for you guys, then I'll copy and paste it. So, depreciation expense for September 30th at month end is B183, so an increase by. Then accumulated depreciation is going to increase by negative 183. Once again, is negative because it's a contra account. A contra account is attached to a principal account or a primary account, and it reduces it. Then we're also going to update payable as well, interest. So our obligation is increasing, and so is our expense. Then on October 1st, we actually paid off our interest now the very next day. So we're going to decrease cash and we're going to decrease our obligation because now we cleared it. We don't owe it anymore. We paid it off, right? So on October 30th, November 30th, and December 31st, it's going to be the exact same entry. We update depreciation and interest. And then on November 1st and December 1st, we pay off our interest. Simple as that. Then when we do our totals at the bottom for cash, we're going to ignore that. But we're going to do it for the rest of them. I'm just going to put in a quick formula. We're ignoring cash because remember, the main topic at hand is accumulated depreciation, equipment, bank loan payable, interest payable, depreciation expense, and interest expense. So I'm just drag this across. So as you can see, our cumulative depreciation is going to be for 1, 2, 3, 4, 5 months, 915. So if we do 5-month depreciation, it's going to be 183.33 times 5. 915 is just a rounding error. That's fine. Then our interest that we owe at the end of the year is just going to be $75, which we're going to pay on January 1st of the next year. Then the total depreciation expense matches accumulated depreciation for the first year. And total interest we paid is $525, which is for a period of 1, 2, 3, 4, 5, 6, 7 months, right? So if we take $75 times by 7 months, right? $75 times by 7 months, it's going to equal 525, which is 525. This is a really good question. It is confusing, so I highly suggest that you guys redo it and understand it properly.